The term corporate loan broker is used in two very different ways, and confusing these two uses will cause real problems for both brokers and their clients. Sometimes it's used as a broad synonym, and other times it's meant to signal a very specific role. And in this video, I'm going to explain both meanings, when each one is appropriate, and what the term actually means when it's used correctly. Because using it incorrectly can quietly damage credibility with lenders and clients, and most brokers never even realize when this happens. So let's start with broad usage. In everyday conversation and marketing, people use corporate loan broker interchangeably with commercial loan broker, business loan broker, capital consultant, commercial finance broker. And in that sense, corporate loan broker simply means someone who helps businesses and real estate investors source capital. That's not wrong in casual conversation, but this is where the problem starts, because using the term incorrectly can create an expectation mismatch that kills a good opportunity before the relationship even begins. And when this happens, most brokers never even realize that that's the mechanics. And here's why. The word corporate carries weight. Clients hear it and they expect sophistication and service. Lenders hear it and they expect institutional rigor. And whether you intend it or not, that label sets expectations. And when those expectations aren't met, deals don't usually fail loudly in explosion. They just die quietly. There's no argument, no feedback, just silence. And brokers are left wondering what happened. And here's why I'm confident saying this. I'm Shane Walton, co-founder of the Commercial Loan Broker Institute. Institute works with hundreds of lenders and supports hundreds of commercial loan brokerages coast to coast. And from this, we get to see thousands of deals and hear what lenders and clients expect in each situation. So what I'm sharing here isn't just opinion, it's pattern recognition. And this distinction shows up consistently in real outcomes. And in a minute, I'm going to give you the simple test you can run on your own brokerage to know whether using the word corporate helps you or quietly hurts you. But first, let's define what the term means when it's used accurately. And when corporate loan broker is used precisely, it does not just mean someone who finds a loan for someone else. It describes a broker whose role is to design how capital comes together, not simply place a single piece of debt. And the distinction matters more than most brokers realize. Here's the simplest way to conceptualize it. Most commercial loan brokers operate in transactional placement. That usually means one borrower, one loan, one lender, one approval decision. And the core question for them is, who will fund this loan and on what terms? And that's a huge and valid, important, critical part of the market. But a corporate level role starts from a different question. Instead of asking who will fund this, the broker asks, how should this deal be structured and financed? And that shift matters because now you're thinking about how much debt actually makes sense, whether different parts of the deal should be financed differently, whether multiple lenders need to be involved, how the pieces fit together without breaking the deal. People hear terms like capital structure and sometimes assume it's academic, but it's not. Capital structure means that you're designing the financing, not reacting to it. And this isn't about finding money, it's about designing the capital behind the deal. And let me make this concrete. If a business needs $100,000 for equipment, the lender usually wants basic financials, proof of repayment ability, details on the asset. That's pretty straightforward. Now, compare that against a $100 million development project. That deal is rarely funded with one loan and one approval. It may involve multiple lenders, different layers of capital, construction financing, followed by permanent financing. And the difference in complexity is why the same language can mean very different things and why using it casually creates problems. In larger deals, lenders care about different risks. Different parts of the deal need different explanations. And one size fits all packaging isn't going to work. And this is also where investment in preparation changes. As complexity increases, the work isn't just more documents, it's more review, more planning, more refinement, more coordination, more upfront thinking and analysis before the lender ever sees the deal. It's not paperwork volume alone, it's designing at scale. And that's where corporate loan broker creates expectations as a term. It signals deeper preparation, more structure, more discipline. And when the preparation doesn't match the label, trust erodes fast. So here's the core mechanism under it all. Everything comes back to expectations. When the label sets expectations that you don't meet, the deal is compromised before you even get to underwriting. This doesn't mean brokers who aren't operating at this level are doing anything wrong. They can still be out there helping clients. The issue isn't capability, it's accuracy. The market is very good at punishing mislabeling, and it doesn't punish loudly, it does it quietly. But on the flip side, when the term is used correctly, that alignment is created before the first document is ever sent. So let's get practical. Here's a simple test you can use to run on your own brokerage. No judgment, just clarity. So, number one, the nature of your work. A, you mostly place single loans, one lender per deal, straightforward approvals or declines. Or B, you regularly think about how the deal should be financed. You anticipate multiple lenders and phases, and you structure that out before you search for a lender. If you're B, most likely corporate is accurate. Test 2 is packaging and preparation. Again, are you A or B? A, your packages are mostly assembled when you receive them, you polish a little and then pass it through. Or B, you spend significant time shaping the package. You're reviewing it, refining it, you adapt presentations for different capital sources. And if you're B, most likely the corporate label is going to fit. And test number 3 is expectation management. Again, A or B. A, clients expect you to find money for them, and speed is prioritized over other elements of the deal and how you structure things. Or B, clients expect you to guide them through a very complex process. You manage expectations on their side before placement and finding a lender. And if you're B, most likely you're corporate. So here's the point. This isn't about status. It's about accuracy. Using the wrong term creates an expectation mismatch. And using the right term creates alignment. And alignment is what keeps good deals moving forward. So let's tie this all together. The term corporate loan broker can be a synonym. It can also be a precise role, and problems happen when people don't know which one of those they're using. So if you want a practical way to build a brokerage that grows into accuracy rather than labels, we have a resource that can help. Comment checklist below, and we'll send you our 100-point checklist for launching and optimizing a successful loan brokerage. It covers over 100 steps, all properly sequenced for building a corporate loan brokerage, getting it out to the market, and producing revenue. And in the meantime, get out there, give big to your clients and lenders, and let's make this world a better place together.